Checking levels, and that looks pretty good. Okay. Stream health. Excellent. All right. Ooh. Hi everyone. Whether you're joining live or you're watching this afterwards, this is 51% Attack, and I'm Kbrot, and we're just sipping and talking charts and catching up on a whole lot of stuff that happened this week. There was just way too much, I think, to put into one of my markets update posts that people like. Not just, it's not going to be necessarily more content than usual. It's just we're kind of going to be bouncing all over the place, and there's a lot of nuance that, as wonderful and entertaining of a writer as I am, it's hard to come across, and so it's a little bit better with my voice, I think. So without further ado, let's dive in. We're not going to start with the calendar like I used to, because there's just not a ton of it, and there's more important things to discuss. So, in the usual way, I'm just going to run down my list of things that I monitor on TradingView, and I'll discuss sort of how they how they relate to and pertain to some of the more broad topics that need to be discussed. And let's dive right in. Starting off at the top I don't know why I organize things this way. Starting off at the top, we got the dollar DXY. I don't think it's news to anybody that it went shooting straight up this week on market fears, as well as capitulation around the world against the dollar from numerous currencies, primarily the yen and the Great British Pound, both of whose central banks are going through major issues right now. You've got Britain, kind of, the UK doing a hardcore supply side economy coming out of both Brexit and COVID. So they're struggling. I'm not an expert on their policy, but hey, they're struggling. And then also the Japanese yen, which I guess I'll just do this chart really quick now. Why am I talking about weakness again in the yen? It's been a few weeks, maybe even a few months since we talked about the yen and why it was important. Just a quick refresher is that Japanese government, their strategy is hey, what's up, JT? Oh, you are up way late. I'm happy to see you, man. Um, so yeah, back a few months ago, we started talking about the Japanese yen, and people are asking why. Like, why is this a thing? They're in a pretty unusual situation right now, which is the Japanese government. Their strategy to get through really back-to-back economic crises of the last 20 years. Remember, there was the Asian financial crisis separate from us in the late 90s, separate from the West. And so they're committed to this deflation strategy, and by doing that, the government itself buys bonds, tons and tons of bonds. They own a staggering and most would say unhealthy amount of their own country's bonds, and so at some point, the big heads, big banks in Japan were like, this isn't going to work, and so they have been trying to punish the government by trying to sink, basically sink the bond rate, or sorry, sink the amount of bonds that they hold on their portfolios, which would send the rate skyrocketing. And the limit, which you can already see sort of forming on the chart, has been 0.25% on the Japanese 10-year yield for a long time. It's commonly called by analysts, far smarter than I am, the very limit that would break the Japanese economy. And so each time they try to get above it, and you can see since for year to date 2022, basically the entirety of the world crisis going on, they have been trying to punish the Japanese central bank by getting it above 0.25, which would result in profit somehow. I'm not going to pretend to be an expert on how Japanese corporations and big banks are going to war, but in general, the number to know has been 0.25. They've been fighting it. Why was this important again this week? Why are we mentioning it? Because it was starting to raise up throughout the August pump, if we want to call it that, for both equities and crypto. Japanese yen was starting to creep up, and you can see if we go down to the daily chart, what caused, for example, today's big, red finish to the week. You can see it honestly kicked off nearly 12 hours earlier with the Japanese central bank buying again just a ton of their own bonds and adding to their position to continue with this deflation strategy, and just absolutely sank the yield. I mean, went thermonuclear for a few minutes. If you were to break this down, I don't know how the chart goes. Yeah, so you can see dropping from that scary 0.25 all the way down to 0.22. Anyway, I don't want to stay too long on this, but that's one of the major causes that led into the volatility at the end of the week and today. What's up, ETH Finance? Good to see you, Joao. JT, late night snacks. Yeah, I know that feeling. I just barely avoided grabbing some snacks because it's well, you know this. You do way more vocals than I do. You know it affects the voice, the vocal cords. So just got my drink. Okay, so that's enough about the Japanese yen. We're tired of that. So that was one of the two currencies that was leading the capitulation against the dollar, the US dollar, really this week and really for the entire year to date. Not a ton left to talk about here. People are fleeing to the dollar out of fear from both domestic and around the country, around the world, and the fiat baskets are strongly weakening, against the dollar, and it's something that's going to continue until it breaks. So no more news about that. Let's just look at levels. I don't think it's worth talking about daily levels. The dollar was just reacting to volatility and fear in other markets, up. So let's pull back to something more useful. The weekly, where is this at? What are some levels we can sort of monitor on the dollar? Here's my shitty back of the napkin drawing of a bold pennant. Gosh, I forget when I drew that. From one of these streams. It ended up being weirdly accurate. This was not intended, but yeah, perfect bull pennant with little flag, 1 touch, 2 touch, 3 touch. I think it's allowed a second touch on the bottom. Anyway, and broke out above. So that was my napkin bull pennant. So what are some levels to watch? We got to go all the way back because the dollar is setting higher highs compared to really the entire bull run. And when I say bull run, I mean the market bull run, the secular bull run from the bottom of the great financial crisis down here. So higher highs, historical higher highs. See these blue lines I drew? I've had these drawn for a year now. I was the one bitching and moaning in summer 2021 that Jay Powell was needing to hop on the horse and fix inflation, but they didn't listen to me until too late. Anyway, so that's where the blue lines are from. Obviously, they were broken out of much earlier than this latest run. But going all the way back to the previous high, because the dollar is on a secular downtrend. It's designed. The modern economy is in the entire West is for inflation to slowly take place, and then you get little spurts, scary periods like now. So it will trend down, but we're at a historic high. There's no doubting that. So we got to look back at the .com bust and the lead up into that and the collapse. And really, I mean, the dollar soared past as soon as it broke 110.25. Breaking up way past the 950 pivot of the .com, the end of the .com. Gosh, so I drew this line. It's a rough pivot. I mean, just something to watch. There's really nothing now until we see day-to-day weakness in the dollar. But I marked, I think, 114.25 as sort of a pivot area. That's coming off of sort of this, again, the .com era, and sort of where the pivot can be. I call it, it's a pivot, a mirror pattern. You just look for kind of rough confluence of support resistance. I think this line's pretty close. You can see it definitely pivoting around this area, a couple of touches. So 114.25 is an area that could be magnetic because of the insane strength of the dollar. And of course, I don't have to tell you that above that would be these peaks, which called a double top, and that's at 120. I'm not gonna say it's impossible. I would never say it's impossible now. The world has gone crazy. Breaking 120 would be truly astonishing. So I'll leave it at that. I think 114.25 is going to be magnetic, unless we see some real fast weakness in the dollar this upcoming week. I mean, it's how far away? I don't even think it's wizardry to say that it's magnetic. It's only 1% away. So 114.25 will represent a little bit of resistance, historical resistance, and so this could be a good area to see yet again. A little bit of weakness in the dollar. If we zoom into the last time that happened, the last time bulls had a chance to get the dollar down was early September. Didn't really do much. They dropped the dollar 1%, and then it kept going on its merry way. So higher highs, higher lows. Dollar is in pure bull mode, which means equities and crypto and other assets are in full bear mode. Nothing more to report here until we see some weakness, at the very least, on a daily basis, and then we can talk about weekly. It's just firing like crazy. I guess the last thing I will say, let's take a look at the RSI, because I can see kind of out of my peripherals that there's a divergence. Let me confirm that. So we do have obviously higher high price on this RSI peak. Higher high price, higher high price. The first RSI peak from back in May is higher than this one. So that's 81 down to about 76.5. And moment of truth, are we still in this divergence on the weekly, which is a strong time frame for divergences? Obviously, this is a higher high, and the RSI is 76.42. It is it is just barely. I'm doing this live, so I'm looking at this with all of you. 76.58 to 76.42, and that's if nothing shifts post market. This number it can shift certainly in the decimal range. So as the DXY sort of rolls over next week, right now you still have a bearish divergence building on the dollar, which is of course bullish divergence for equities and crypto because there will be pressure off. But it's hanging on by a thread. I mean, you're looking at it with me. Another green week, and yeah, the divergence will go away. Now, as always, divergences aren't the end all be all. They don't always have to play out, but it's a really nice thing to watch for. It falls into my what I've been writing about, especially recently, is how probability should be treated like a rubber band. You're pulling the rubber band back, and right now this divergence, a double top, not a double top, a double divergence, one here and one here. Barely. Double divergence is really pulling back the rubber band on what is ultimately a good thing for Ether, for example, because it suggests that there's a lot of pressure to pull the dollar back down. However, divergences are not guarantees. And if this bad boy surges, if we see some capitulation in markets, 114.25 could show up, and it might even go higher. Deciding if I want to get into bond yields now, because that's really the root of why I did this video, for the nuance and the explanation. I guess let's take a look, because it's important. I will make this as a separate chapter in the video, and let's dive in. So my standard chart, I post this. I actually haven't been looking at it much that recently, or I haven't been posting it because it's been more or less the same. This is the US 10-year yield, obviously going up. The 10-year yield is associated with downward pressure on equities and crypto and risk assets. We've discussed that before, and it's going up. No real surprise there. I've been looking even more so at the US 2-year individually, and I also keep a chart of. I kept a chart, I should say, of the 10 over the 2-year, because that is one of the major recession indicators. When the yield curve inverts, the 2-year goes above the 10, and you get a negative percentage here. That happened weeks ago. We've talked about it endlessly. We saw it first in March, and then for good, or at least for a long period of time, starting with the June drop, June and July drop. So. Anyway, back to the 2-year, which is more immediate, and it kind of gives you a little more immediate information, because whatever's happening in the 2-year suggests what market makers, the smart money, is expecting for what else, the next 2 years, the near term, with it absolutely skyrocketing. The 2-year's been up. Yes, it goes up, but these recent 2 weeks, I mean, plus 8%, that's enormous in bonds. And this is a derivative, it's bond yields, but it still goes. Bonds are a large, slow-moving market. It is a giant friggin' freighter where the market makers play, where the smart money plays. To see it, jerk up 8% in back-to-back weeks is unusual. It just goes along with saying that this is a very unusual time, very tumultuous in markets. And so the 2-year, yield going up suggests that, they're going to be, that the bonds themselves are going to be worth less within the 2-year period. There's fear. There's real fear that the next 18 to 24 months, we'll say 12 to 24 months, could see, more fear, more volatility, and lower prices on bonds and other assets. Going down this list, and trust me, this is coming to a main conclusion. We're going to look at it in a second. The thing that everybody's been waiting for. It'll even be another separate chapter. But before we get to that, here is one last comparison chart. This is the U.S. 10-year against the U.S. 3-month. And this is a favorite chart of the Fed and major banks. This is another yield curve that they look at, particularly to, again, track when a recession may be rearing its ugly head. I've personally found, as I go back through so first of all, the 10 over 3-month has not inverted yet. It's getting very close. I'll talk about that in a second. The 10 over 3-month tends to be ever so slightly closer to the actual recession, or in the case of March 2020, deep market correction. But in general, we can look back in history. And so the 10 over 3-year tends to cut it a little closer to the actual date of the recession than the 10 over 2-year, only by about a month. It's not a huge difference, but it's just to say that the 10 over 3-month, having not inverted yet, could just be lagging. There's no reason to think it won't invert. But this is kind of what it looks like in prior secular bear markets, the .com bubble and the GFC. Does the same thing as the 10 over 2-year, just ever so slightly shifted. So you can see like January 01, for the rocket ship. I've talked about this before, that recessions don't start when these things are down. They start when they rip back up, when the rate cuts come in. So just reiterating that. So here we had like January 01 for the 10 over 2-year, and hopefully my point still holds. So there's a little bit of, you see what I'm talking about here? It's a really minor thing. It's like a month pushed. There was kind of like a little resistance in January 01 for the 10 over 3-month, but then February hits and boom, it gets the same rip. You can see these kind of red bar like trying to come back down, a little bit of resistance, and then the green bar comes in February. So they're very close. You can track them together, but there's a little bit of lagging, which makes this really interesting because as I just showed you, the 10 over 2-year is deeply inverted and has been for 3 months now. The 10 over 3-month is doing this thing. I know this looks really bad, but it is not below zero. It's doing these like stings down over and over and over and over and over, almost as if there's like a living entity trying to like bring it down. Maybe that's just me drunk and the anthropomorphizing market makers. But it is an unusual thing to see these repeated tests. I couldn't find anything quite like it. There's plenty of downslopes leading into the inversion. This is a downslope, and prior to this one, there's a downslope, but there wasn't like this repeated test of this area. It's really, it looks really manipulated, and I don't have an answer for it. It's just something unusual. Heck, maybe it did go back up with the close of this crazy week, September 19th. So maybe this means something. I'm just speculating now. Maybe this is the one time it doesn't invert and saves the market. We'll talk a little bit about more Hail Marys the market could have later on in the video, but maybe that's an indicator. Okay, so let's get to probably why a lot of you are here, which is I talked about, I wanted to discuss why the FOMC was so jarring for markets this week. We had expectations going in that they would raise the federal interest rate 75 basis points. That was expected. That's what we got, and people were confused, a little bit angry that with that expectation being met, the market's still rejected off of it. And we're going to talk about that. So the actual interest rate hike itself for September 2022, which will be enacted in a few days, was expected. What was not expected was the federal dot plot. they dragged forward the um, or accelerated the rate hikes by nearly about 6 months. And it was something that had been speculated. You could even say maybe priced in by bond markets, but it had never actually been said. And that's what we got. The Federal Committee of Governors and Jerome Powell yanked everything forward, and we're going to take a look at what that looks like. So really quick summary is that whereas markets were kind of pricing in about 4% interest rate, federal interest rate for the end of the year, and that alone, sent the markets down in June. That news alone was pretty frightening when they started pricing that in. Then on this meeting, they announced they're now looking for 4.5%. Towards the end of the year, I think it was 4.4% actually. That's dragging everything up by 50 basis points. And so whereas before, again, markets were pricing in an expectation of 75 basis points in September, and then probably 50 in November, 50 in December. And that's no longer possible, at least, not without some change in the data, because they're saying everything is data driven, their decisions. So what that did was, you can see here, I guess there's no real purpose to saying November. November is expected to be 50 to 75. We don't know yet. But now December, which previously was like 25 and 50. Yeah. So this was like 70 to like 30. And there was an outlier here. There's still an outlier here at 450. But now the expectation is at some point in November or December, another 75 basis point hike. So that was jarring, because the market is forward looking, and that's a forward looking figure. However, that's not the only thing, and that's probably not even the easiest way to picture what I'm describing, again, which is the rate hikes not just meeting the expectations, but being dragged forward and dragging out the usage of financial tools to bring down inflation. So for that, let's take a quick look at what happened to the futures for April 2023. Okay, so this is how the futures market was pricing things in prior to the FOMC meeting on Wednesday. Still wasn't great, but prior week, futures closed at 4.4%. So this is for April 2023. They're being purchased in September. That's why we're looking at the chart. But they are looking forward. This is the April 2023 chart. So futures are looking at 4.4% for the ceiling for April. And prior to that, they were also buying in. They were pricing in September 2023 futures. So we're using September as kind of like a look for. I could use December, but I'm gonna use I think it's September for this data point. Boom, September 2023. And so I'm gonna click this, and then we're gonna go back. So this is, dang it. One moment while I pull up the chart. I did not have it saved. There we go. Okay. So now, again, going back to the week of September 12th, 2022, like literally, the open markets, they were pricing in a ceiling of 4.2 for September 2023. So if you're remembering what I just showed you, and previously they were pricing in, what color am I using? Oh man, this is gonna be hideous. This is gonna be great. Okay, so they were pricing in up here. The rates were gonna go up. This is what they're pricing in. This is us now. This is April 2023, and then September 2023 was a little bit down. They're pricing down, and probably were hoping for, markets had probably priced in and were hoping for maybe an even slightly lower April, like some good data comes in, and instead of hitting 4.5%, they hit 4.2%. And then September's 4.2%. And then instead of a downslope, you just get, straight across line. And everything would have been pretty hunky-dory until the recession starts. We'll talk about that in a second. Because just a flat line is not good either. It just means the end of the most inflationary pain. So this is what they're expecting. I guess I should put, can I do text? Oh, that's some big old text. So let's say, this is what they're expecting. This is why Wednesday changed everything. So they're expecting something like this. Okay, they're actually expecting. Let me. This is 4.2 is speculation, so we'll just say 4 to 4.5%. So it could have been a straight line, could have been a downward line from April to September. Now, what changed on Wednesday when they brought forward those hikes with that kind of acceleration? What you ended up with for April 2023 now, and we're going to hit enter correctly. You can see everything jumped, and futures are now pricing in. Looks like a ceiling of 4.7, and the floor is now, what did it open at? 4.42. Fine. So I rounded this one down or up. So I'll round this one up to, we'll just say 4.5%. It's actually 4.4, but just just for easy numbers. What was the ceiling in April previously? 4.5 is now the floor, and then it just keeps going up, which means they don't, they haven't priced in May yet necessarily because they're waiting on October CPI, but May could be even further, and it's just to say that there's no. They took away the top. The Fed took away the top that markets had priced in, and not only that, but then now that also pushes back the period I was talking about where we see maximum pain in relation to inflation coming down, not the recession. I'm talking about the lead up, where essentially it's almost good things because markets tend to go up and inflation starts to come down, but it is rather boring. We've got. Sorry, losing my train of thought. So they removed the ceiling and created maybe a new ceiling higher at 4.7 in April 2023, or it could go even higher. That's yet to be seen. The point is the floor is now, basically 50 basis points higher and faster. Because now, again, keep this in mind. So 4.5 to 4.7. Let's go back to September of 2023. This is next September. And what happened in the week? We see it went up from, again, a ceiling of about 4.2 before. Zoom out so you can see the number we had. Remember, we were saying 4.2. That's now the floor again because everything's been pulled up. And the ceiling is actually, this is closer to 4.5 when I was planning this earlier in the week. So the ceiling for September is now basically up at 4. It's basically 4.7. It's really the same block. And so now you've got higher rates lasting for longer because, initially this could have been, just going back to what I was saying before, there was a chance that April topped at 4.5 and September had a long way. September was at 4.2, so they were, pricing in a little bit of a downslope, or maybe even hoping for a more pronounced one. Like maybe if April came in at 4.5 and good data came in, maybe September futures would turn to 4, or maybe drop back under 4. Instead of getting anything like that, they got at best flat. And then after the FOMC, you've now got, let's see if I can do this. You've now got April starting up here. That should be red because it's bad for us anyway. You've got now April starting up here, and September is frankly just at best matching. There's no downslope. These were both, what did I say? They're both 4.5 to 4.7. So now you've got this completely prolonged. There's no hint yet of a pivot. This was the potential pivot in April. They were hoping for a ceiling of 4.5. Fed can say, hey, we're going to pivot here, and then it just flatlines into September, and then it can drop down into the end of the year. That's gone. The pivot, it could start after April, but even just moving it that, let's say, 1 month to May or June, I mean that's a huge shock to markets, especially with 50 basis points. About to say Bitcoin, especially with the 50 basis point jump. So now you've got, floor and ceiling of, what did I say? We're fudging the numbers a bit. It's 4.4 to 4.7, but the case still stands. And I guess I can just copy and paste this because it's the same damn thing. So you've now got this line, which brings us to the last part, and something that I've talked about quite a bit in posts, which is when does the recession, the actual dump, the drop, the scary moment, the doom, when does that actually happen in relation to all these rate hikes, the pivots, the stagnation? When does that happen? It's an average of 8 months. average of 8 months. So whereas previously the pivot could have just been in April and been done with, now you've got uncertainty, and markets don't like uncertainty. By removing the ceiling in April, the earliest you can now see that sort of band-aid rip is December. And that's something to keep track of. It's going to be just drawing out that uncertainty, because even though the average is 8 months from when the last rate hike occurs, it doesn't have to be 8 months. It could be 7. It could be 9. It could be 12. It could be 4. But with the average being 8, there's uncertainty introduced back into the markets. The ceilings for the rate hikes are currently gone, unless we get into kind of a philosophical barrier. And yeah, overall, that uncertainty was introduced rapidly with gusto on Wednesday, and that is why the expectation for 75 basis points being met was not the issue. It was the dot plot and what they expect the rates to, first of all, continue at, how long they expect them to stay high while inflation is battled over, I guess, apparently next summer 2023 as well. And then uncertainty as to when the rate cut can happen. So just to go over that timeline really quickly again, potentially, if April is the last rate hike now, if 4.7 is the ceiling, if we're so lucky, typically 8 months after the final rate hike is when the rate cuts occur. And counterintuitively, when the Fed cuts rates, it tends to be when the drop happens. And you can see that illustrated on the yields chart. Where's the best thing to show that? I would probably just do the Fed rate. It shows up. I can't remember the ticker. FFR. Is it EFFR? Let's see if this tracks it close enough. Yeah, sure. Okay. Well, here's COVID. That one's, again, I don't want to base anything off COVID. That's a unique example. Even though it fits the bill, February 24th, rate cut, and then they went to 0 and ta-da, plunge. But let's go to something that's actually more easily trackable. So boom, you can see here the building rate hike, which is what we're in now. And you saw the Fed starts to here's the pivot in July. They straight up started to ease off a little bit early. So you could call this the rate cut. You could argue that with me. It's a little more gradual. But it did start. I'm not going to deny that. But then you get, again, another bit of stagnation. Boom. Right here. The actual drop in the actual drop in rates, the rate cut, the big one, September 08. Nothing else needs to be said about that one. What's up, Arrowwind? How's it going? Yeah, EV Mavericks. Got mine. Got my Maverick. Got my Panda. It's great. Never need to sell those. And then this chart, yeah, more or less the same thing. This one, you could say, it's a little more gradual, but it's still a rate cut. Still a rate cut. You can see it's one that, look, whether or not it's gradual or a dump in the rate cut. I think you're not going to argue with me too much that it is the cut that that precedes the actual recession dump, the doom. So you've got the cut here, and then boom, January 2022. Sorry, 2002. Take a look at that. So that's pretty much it for the Fed. We talked about the rates. The last thing I did want to bring up. Let's go back to that chart. I made an offhand comment that I do want to quickly elaborate on, which is that you can fight the Fed. And that's to say, it's actually more to steer away people from just constantly saying, don't fight the Fed, mostly due to fear and risk management, because that's my main thing. As the rates continue to go up and stagnate, that's not the scary part. And in fact, the market can go up during this. Our closest composition to the current market, in my opinion, I'm not going to go back to the SPY chart because I want to get this part over with. It's probably something like, the 2005 to 2007 period. So right here, I don't know if the slope is the same. I'm doing this live. I'm going to go back and see if our slopes match up. They do not. But anyway, not even close. Although this lead up, gosh, if you take out COVID, maybe that's the answer. This slope in federal funds, all right, federal interest rate going up, does match this one. If you take out the COVID exception, it could have actually lined up. But that's not my point. My point is, as Fed rates first start to go up and continue up and stagnate, the market does go up. 2005, 2004, really, mid 2004 to 2007 was fine. I believe the market does get another complete leg up. Where was I just at? Mid 2004. So yeah, look at this. Here's mid 2004 up until 2007. That's just higher highs, higher lows. There's no issues there. So this isn't a time to necessarily just be outright fearful, and I don't want anybody terrified as the funds rate. Sorry, Jesus, as the Fed rate. Let me take a sip. As the Fed rate increases and stagnates, don't be incredibly fearful yet just because of that. The market can go up, and let's go take a look at some charts to see what that might look like. Whew. Okay. Crypto. Bitcoin floundering. It has yet to close below this line that I drew. I guess this is one of the July sting lows. And it has been a pretty important line. You can see it's resting on it literally as we speak. It's 18,975, I guess, was that low that I randomly drew. So that's a little bit of a pivot point. Next one would be the 300 week. Sorry, if this doesn't hold. And keep in mind, Grandpa Bitcoin has not closed below 19,000 on the weekly since it went above it back in 2020. So this is a pretty huge weekly close. If it does close below it, again, it's not game over. You look for a confirmation candle. We would see if next week they try to come back up above it, immediately retake it. If that happens, fine, off to the races. If it closes below 19K, maybe confirms that it's going to stay below 19K. You've got, 17.5 here, which is currently the 300-week moving average. I measured that separately, but it's there. And then if it breaks that, I have I have other targets. This is a Max Bollinger Band target that I calculated manually by hand. Gosh, months ago at this point. So I leave it up. I don't know if I have to reassess it in the event of breaking it, but it's 13.5. It's not some crazy number that you guys aren't imagining it could go to should this pattern play out of breaking 19K for the first time and staying below it. But that's Bitcoin. It doesn't look great on the near-term charts. It's kind of just, and I don't want to do too much near-term. Let me get rid of the volume so that's not blocking us. Yeah, I mean, it's floundering. It's finding resistance. It's currently below. It's kind of forming an evening star again. It's not quite there. I'd say if it gets back below 18.5, to close out today, maybe that's an evening star that, it seals the deal. Maybe it's not. Doesn't look great on the daily. And the 4-hour, when I last looked, it was failing again. Yeah, it just keeps bumping its head against the 50-period average. Again, if this becomes here's a double top on the 4-hour, maybe, if these next few minutes, when's the candle close? Oh, we just started a new candle. Okay, so it has a while to go. So there's not doom and gloom yet, but hey, it's gonna be an important 4-hour candle. They're gonna want to see it bounce and hold this line yet again. It just keeps, it's market makers. They're fucking with everybody. Keep going, but they know how important this line is. There's a reason for it. Down below the pivot, back up, down below, up, and eventually Bitcoin will run out of Hail Mary plays. Is this the one? I don't know, but it's something to watch. Clearly, it's important. I'm not making it up. The market makers are definitely fucking with people going below and above it. Onto the asset we actually care about here is Ethereum versus the US dollar. Well, might as well take a look at the 4-hour chart. It's weak, not as weak as Bitcoin, but certainly weak. You can see it's just constantly finding resistance. Ever since we dropped below, again, the bottom of the channel, the summer channel, it's just been bonking its head up against it. one in this wave, in this large wave pattern, and then also with individual stings up, just constantly testing it. If you're one for triangles, which I've kind of given up on triangles, I don't like them, but it is technically an ascending triangle. Got a line, you got higher lows, you've got more or less stagnant highs, so it could certainly bust up through this. As of now, it's not looking like it, but there's a long way to go. The candle just opened. It would have to close, below these moving averages. Really, you can see how everything is all together. These lows here, it's all around like what, 1300 to, not even. It's actually 1310 to 1315. Pretty much everything is in this area. If it breaks down the next few hours, then maybe a sign that first of all the low 1200s is coming back, and then maybe we lose that. Going out to the daily, same thing. This area is just ultra key. You can see there's a bit of an evening star being hinted at, but nothing to be frightened about yet. It has to, definitely start confirming below those 1310, 1315 area. Not great though. You can see the daily's doing the same thing. It's just sort of bouncing down off the bottom of that channel, which again was sloppily drawn by me 3 months ago, 2 months ago, 2.5 months ago. I mean, I sloppily drew it. It's just lines. They're not my favorite thing, but I mean, you can see. I mean, it's clear. It's clear as crystal that they do matter. It was the pivot point here. As soon as it dropped through on September 20th, boom, dropped straight down to the next resistance, and it's just testing it now. So we're testing the underside of that channel. We're gonna want to retake it pretty darn quickly. Otherwise, this is the daily chart, which isn't the highest, but it means something. This is a confirmation pattern. If this evening stars, if this becomes a red candle down to like basically the low here, 1260 or below it, 1240, this forms a red candle at at today's rollover into tomorrow, the close. Looks like a rejection to my eyes at the channel, and we'll go from there. And you can see once again, resistance, currently support 1225, 1230. Break it, and the next thing down is probably this pivot that I just kind of eyed. It looks like around 1125, 1130, basically another $100 down. 1130, and then probably the bottom of these dips. We'll reassess if it actually comes to that, but 1030. Honestly, we keep going up by $100 on the 30s. 1030, 1130, 1230. Those are kind of your numbers to watch. Right now, a rejection off this summer channel that formed. Pulling back to the weekly, it's a doji. There's nothing really talk about here. Maybe on the daily, the Stochc RSI is maybe curling back up. That could be a good sign if both of these get back above 20. This is on the daily. I went back to the daily, so maybe some near-term bullishness. Not yet though. I mean, the mean is still bearish, so that's not me calling for bullishness, but it could if they both break above 20. Back on the weekly though, this is more interesting because it means a lot more. Sure, we've got the doji forming at the bottom of the channel, and again, this is a shoddily drawn channel. That doji could actually be forming on top of this line. This is not what I would call like doom and gloom yet. It could bounce here. Going down the momentum oscillator though, the Stochc RSI. Blue below orange, that's the leading oscillator below the average, the mean. That would suggest that, things are maybe this area up here. The way the Stochc works, just as a reminder, is, it pretty much works in terms of like bearishness and bullishness. It's not oversold and overbought. It can stay up in these regions for longer than something like the standard RSI chart. So this is bullishness starting to roll over. That is, it's still demonstrably bullish, pretty much near 80, a little bit under, but curling, rolling over does suggest that the bullishness is ending. So still bullish, but lessening. You get below the 50s, and things start to get a little nasty. Breaking down from bullishness, the last time we did that, definitively was mid-April, and it dropped a lot. I don't think we're going to drop this much again. That's 60%. Actually, 70% to the bottom. I don't think there's enough. There's not enough liquidity in the market to do 70%. Although, I mean, nothing's impossible. But I'm not calling for this. I'm just saying another 70% would be like $400. Um, I don't think that's gonna happen. We'll reassess if everything breaks down. So that's the US dollar. More interestingly, though, this is something I was just kind of picking at today and sort of seeing what's going on, is the ratio. The 4 hour, 4 hour had a little breakthrough. It's been bullish for a while. So going off my usual metrics for like how do I call for failures and victories for bulls and bears, is usually like, when you're in this bullish area, it's pretty simple. Can you get above both the price and volume of the prior area? The prior high of the prior bullish area. So that would be over here, and the high over here would be 0716. So that's certainly a major target to get bullish on. Again, in the near term, this is only the 4-hour chart, but 0716 would be good. Pulling back out to the daily. Oh, this is the one I was talking about. So on the daily, pretty similar targets. You've got probably the high of this candle here is more appropriate than just the flat. So 0708 would be a target on the daily. Well, first of all is the 10-day moving average, so 0703, 0708 over here, and then lastly, look at that showing up again, 0716. There's confluence. Here's the high. So there's a little bit of a ways to go to get back into bullishness, but you're seeing the ratio chart. It is rolling up. So bearishness on the ratio is sort of coming to it is lessening. Doesn't mean it's not bearish anymore, but the bearishness is lessening. This is the daily chart, so it's something actionable potentially. It lasts for weeks potentially. If this rolls up both above 20, maybe we're seeing a little resurgence in the ratio. However, even more interestingly is this cross up here. You're looking at these MAs, you see orange above white. So that's the 100-day coming above the 200-day. And it's not a common event. It doesn't happen that often. We got to go all the way back. And it tends to be, if we got to really go back, wow, for that cross. Holy shit. We're in, February 2021 was the last time we saw the orange above white. And I believe the other MAs were above, similar to now. Yeah. So the setup is fairly similar to February 2021. And even though there was some tumultuous action in the immediate weeks, again, this is the daily chart, in the immediate weeks, it did somewhat portend a big bullish rise for the ratio. So you figure, the cross happened in late February, and by basically the end of March, was the start of the big bull run in the ratio, leading into summer 2021, where ETH went up, from roughly a buy-in of 0.0302 to like 082. So yeah, went up 172% against Bitcoin. It was a magical time. Could we be seeing that again? Possibly. I mean, it's not a very easy to falsify cross. I did go back and look at like other things, when would be a bad opportunity. February 2020, again, this one's tough. COVID is a massive exception, but we'll count it. Technically, the cross up was actually a top here for quite a while. It triggered in mid-February, and we weren't above that until July. So for a midterm to long-term investor, I mean, I think it's perfectly valid. If you wanted to trade this, it does seem to have some value. But you might be waiting, 3 months potentially if it looks like 2020. Over here, the MA setup is different, so I do want to highlight that. This is when, I guess the lower MAs were, they were above it. That is the 10 and 20. Here's a cross up, orange above white. Not good. I'm not going to say that's, you were waiting a long time, a very long time for new highs. So this one was a failure. Any other good ones? Here's the bear market, the start of the bear market, orange above white. You were waiting from mid-February to, what's the new high? May. So again, another 3 months. Not the worst thing for midterm trades. And then here's orange above white, which is the 2017 monster Could be seen as an exception in the other direction, but ETH obviously shot up quite a bit in that spring. Something to watch. I wouldn't hang my hat on this indicator, but it is interesting. If there's it seems to me somebody's reacting to it because there's been a little pop in the hours surrounding the cross. But as we saw, it can bounce around this area. Oh, wait, that's not the right one. I meant to do 2020. Yeah, so it can bounce around this area for a little bit, but it might be something to watch. And so that's the ratio. I don't think there's anything to watch on the weekly yet. Just dojiing. Just a doji in between the MAs. So let's move on. I want to do most of the remaining TA on SPY, so I'm going to quickly go through everything else. Because as usual, I'm running long. I'm always running long. First up, the VIX. Obviously, VIX volatility is up quite a bit this week. The indices all dumped. Very, very scary. So the VIX went up, but maybe not enough. We'll take note of the gap here, the weekly gap. I don't know if it exists on the daily. It does not. So the gap's not terribly strong. There's a small one here at 20, just above 27. It's 2 days removed from it, so I don't know if that gap's going to fill. But I don't want to get into the weeds on volatility. Basically, the main thing I wanted to say is that obviously we saw a big ramp up in VIX, but honestly, it wasn't a great spike to call a bottom. I mean, usually you see like some major shit happen. This spike wasn't even above the rest of the year. I mean, June was higher, May was higher, March was higher. So there's no divergence there. It's just confluent, lower highs, which normally you'd say is a good thing, except, bottoms. I'm going out to the monthly here, all the way back to the monthly. The bottoms usually you see bigger volatility, and this is, I mean, look, here's 2018. When oil spiked, you've got the end of 2018, even the end of 2018, which wasn't a particularly great one, was higher. The Christmas dump of 2018, that was higher. This is higher. Here's COVID, again, an exception, but whatever. Here's 2015 oil crisis. You've got the 2011 Fed policy pivot, much, much higher. Obviously, great financial crisis and .com, we're well into the 50s, and right now we're just, it's spiked, but it spiked to like 30, 32. It's kind of fucking pathetic. If you're going by this chart, that doesn't look like a bottom to me, and that's a little worrisome. Just another puzzle piece. So let's keep moving on. Let's look at tech. What I really want to talk about with pretty much the other three indices is this line, the white line, the 200-week moving average. It's pivotal. It is absolutely pivotal. It is the mark. It is the decision point for markets. Don't believe me? Let's zoom out. What do we revisit each time in this secular bull? Pretty much 200-week. It's a bounce point for here. Didn't quite reach it in 2018. You can see the spike down in 2015. We don't breach it. When we do breach it, we see, again, 2008. This is a key point, and we've already bounced. We more or less came down to it in June. If you squint, it's not right on it, but it's pretty damn close, which means this is actually a retest. Also kind of bearish. But until we're below it, we're not below it. Until we're below it, there's a chance. To add to that is we didn't see the tech close at a lower low. It didn't even set a lower low, I don't believe. Yeah, it did not set a lower low, even on the sting down. So we've got higher lows still on tech. This is a very bearish look. Momentum is coming down. It is absolutely bearish, but there's still a chance. To illustrate that, let's go to IWM. This is the small caps. Same story for the weekly in that it did not set closing lower lows. It did not set a sting down lower low. Still higher lows. However, it is below the 200-week. And if you take small caps to be representative of just risk on assets as a whole, this is something that needs to be reversed immediately. Same thing we saw at the end of July. This needs to come back up immediately. We need to see it use this higher low and ratchet back up. If we confirm below the 200-week, get a green up to it and then get a red back down from it, more than likely it's going to be bad, pretty bad. But just to illustrate that the IWM moves faster than other markets, you can see back here in 2018, in the Christmas dump, it went below the 200 week and ratcheted back up. That's what we need. Pretty much a V or a very sharp U or a W bottom here. It needs to come back up immediately. I'm talking, we can look at it together, maybe like 4 weeks. Let's look at 2015. 2015 small caps dropped below. It took its dandy time. This was 6 weeks here, so maybe we have a little more time than we think. I don't know what the MAs are looking like. This is red and green below blue and orange. So blue and orange, it was back above, and I'm just looking for trends and patterns. I'm not doing anything too mathematical here. It did get back above the 200 week by the time the 50 plunged below the 100. Meanwhile, 50 is already below the 100 here, so that's a little worrisome. That's a different chart for small caps for sure. And yeah, going back, you can see the white line 200 week is key. It tests it, it drops below it and gets right back above it, or we lose it for a long time, such as in 2008. And it didn't exist in this. The ETF didn't exist in the .com, so can't see that one. Going over to the Dow, it's the same story. We're at the 200 week. It's actually closed below it. This is the most bearish, in my opinion. This is the singularly most bearish chart we will look at today. If you believe in Dow theory, that the Dow leads markets down and not tech, which honestly I don't really have an opinion. They seem to oscillate. Sometimes Dow leads, sometimes divergences matter, sometimes tech lead. Quite often we see tech lead. But Dow set both a closing lower low. You can see close in June was 298.72, and this week saw 295.86. That's a lower close and also a lower low overall. You can see the sting down here was 296, and this one was 292. So we've got lower lows on a retest, frankly, closing below the 200 week. The Dow is looking really scary. Unlike IWM, it does not have dips and recoveries below the 200 week on record, at least going back, for this millennium. We saw stings down in 2015, but it never closed below like we did. Obviously, we closed below in COVID. We're not talking about COVID anymore. That's an exception. Here, we saw, again, wicks down, but it never closed below the 200 week. And of course, here's the financial crisis. And I don't know if the ETF existed. It was very young in the .com, so you can't really tell here. If you extrapolate this 200 week here, maybe it closed below in 2001. Actually, well, I guess it doesn't matter. My point still stands. Closing below the 200 week for the Dow is extraordinarily bearish, and suggests there could be some more just downward movement, maybe even capitulation. It is probably the one chart that that genuinely frightens me now, because if you go off data, this is saying plunge, and it would be not timed correctly with anything I've been discussing, like rate cuts and seasonality, but them's the breaks. So the Dow is extremely bearish. Let's do. I want to do a little bit of TA on SPY. I guess we'll do that. Okay. Oh yeah, I lied a few weeks ago when I said I was deleting my lines for the year because I was done with them. I love them too much, and they helped us a lot, so I kept them. And sorry for the confusion. What I have been doing is I make the ones that are no longer immediate targets. Actually, this one needs to be. I made them thin if I'm not actively watching them. Some of these like up gaps. So here's what the SPY is looking like. So this is a rectangle because it was a gap on the daily. It has been filled, so I'm removing the rectangle. I'm just going to leave the lines as lines, lines of resistance. If we go down to the daily chart, I promise you they do interact with old levels of support and resistance. You'll just have to take my word for that one. So on the weekly, first of all, we've got a weekly gap down. And boy, if you think market makers don't like daily gap downs, they really don't like weekly gaps. So this is going to be a huge bit of magnetism if the market can turn around. You're going to be looking to watch this area. It's, again, back up to the 385, 386 area. Again, we're looking at the SPY, which is a proxy for the full fat S&P. But on the weekly close, similar to the Nasdaq and small caps, we do have higher lows on close and higher lows overall. The issue with this, and what kind of ties into the Dow's far more bearish look, is that because we got higher lows, even though that's good. Again, if we see it bounce here and confirm the bounce and head back up, then fine, everything's hunky dory. But the issue is it means there's no divergence yet, and we've really been looking for a bull div, bullish divergence on the weekly. We had one here. We had one print. This was a Class B divergence. We talked about it way back and called this run into August. We said that we got a lower low price and a matching. This is crazy, and exactly matching to the decimal RSI 3028 and 3028, which makes it when it's flat on one of the metrics, it's a Class B. So this is a Class B bull div, and look what happened. Up. Now it had a local top, but we were given a heads up into that movement. So divergences are clearly, they played a big part in 2022 already. So we're looking for more. Having higher lows is good because it suggests, that the trend could be, going the other way. But it also prevents us from getting that divergence we so desperately want. Because if this had closed just a little bit lower and the RSI was still way up here, I mean, that would have been one juicy divergence. But we don't have it. So we're going to stop talking about that. Moving down to the daily. So we're going a little bit, we're zooming in the microscope. We're going to see what could happen in the coming days. First of all, we've got just another gap down. So we've got two gaps here. We've got one here just above 376. I'll draw them out in a second. And we've got one from yesterday, Friday, which spans from 374 all the way down to 370. Pretty big gap. As we've seen this year, the 3-day rule just keeps working. At one point it's going to fail, but it just keeps working, and so we're going to keep tracking it until it fails. Back in last week's gap down, we counted 3 trading days from the gap. Here's the gap down: 1, 2, 3. It was not able to close above, and boom, on the 3rd day, God said, "Go fuck yourselves." On day 3, it broke down. So. Actually, we can leave that gap because it still has to be closed. I guess it's more like this now. But I am going to copy paste it to get our next targets. We've got a tiny one here. That's close enough for surgery. And then this is the most recent gap down. So now you've got 2 bits of. So gaps are 2 things. They're magnetic, but they're also resistance. So, one gap down. So we've got 3 days. We'll have until roughly Wednesday to see if we can get back above 374. That seems pretty damn likely to me. Just based on the oscillators. Sure, we're fully bearish on the daily. That's we're deep bearish on the Stochh RSI. But the standard RSI is oversold, and the market does not like to be oversold on a daily time frame very often. It doesn't stay down here for very long. I don't even think we touched it. We have not touched oversold since January. And here, this is actually a decently long period to be oversold, and you can see a lot of volatility was occurring to create that. You saw these sort of stabs down. But even then, this is incredibly volatile, incredible over bearishness, and even that only lasted, what was it, 4 or 5 trading days. So, it's almost always, a good time to start looking for a reversal when something like the daily, certainly the weekly, but even on the daily, when you see it oversold like this, for me, it's a good risk reward, and I do like to, start considering trades, and I do factor it into my crypto positions. So SPY is oversold on the daily. It's got 2 magnetic gaps. Well, actually, it's got a whole bunch of gaps. It's got a whole shitload of up gaps to fill, but let's just look to the near future. We've got 2, from 370 to 374. That seems pretty likely, but it's going to meet immediate resistance again at the bottom of this next gap, 376. Could break this gap and then get trapped in here and then maybe break on through. That's perfect what a perfect way to reverse this this nastiness of the week would be to get, a nice lightning bolt pattern, like break up through the gap, bounce around here, set some higher lows, break back up to the next gap, get back above 383. Like you can sort of picture how this happens. But the bearish case is still there. We could see January where the RSI remains, depressed for even longer. We are still, fully bearish on the momentum oscillators. So there's kind of an equal. It really depends on how you like to position yourself. Gaps have been great targets. Like even in these failures, you can clearly see. Look at day one of this gap. I mean, boom! It shot right up to the gap, right up to it, spot on. Sorry, not to this green rectangle, which is what I drew afterwards, but to the low that created the gap, 388. It shot right to it. So you can certainly use it as a target. It's been really accurate, even during failures, even if this is for some reason a failure. But it's not a guarantee. It's gonna also be resistance, and we're not far from some pretty scary numbers. 366, which is basically kind of a mixture of the summer low and the summer pivot. And below that is what I at some point calculated as our next target. I don't remember where it comes from. I think from 2020. Yeah, it's a pivot from 2020. It's 357, but we're not there yet. But I'm gonna leave the line just in case we break through. But being oversold and with up gaps, it does seem like there's some magnetism to have a green start to the week. Divergences. I think I mentioned it, but for all indices, the extreme downtrend of the past 2 days deleted any bullish divergences on the daily time frame. So there's no bullish divergence for us to work with. Some people do draw divergences on the momentum, the Stoke RSI. There is a slight one here, because we didn't zero out yesterday. So technically, you can draw a slight upward line on the momentum here. Lower low price, higher low momentum. That is a divergence that people do look at. I don't adhere to it very much, but it's there. Otherwise, on the pure standard RSI, there are no bullish divergences. They are gone from tech on the daily. They are gone from SPY on the daily, lower low, gone from small caps on the daily, and certainly gone from the Dow on the daily. So no bullish divergences for us to look at. Some really important targets. Let me talk about, since I've only been able to do written posts about this, I think this is a good time to talk about the major indicators, the unbeatable indicators that have been contradictory this summer into fall. So back in July, it was actually, I can pinpoint the day. It was the day that SPY recovered back above the 50. So July 19, which is actually when Ether was also showing strength as well. We saw, I don't have access to the chart right now. I got it from another analyst, but basically the breadth chart, which is, the number of, negative stocks versus positive, and where the volume was going into, it went from fully negative, basically off of this July 11th week, where it kind of stung down, went from fully negative at negative 800 all the way back up to 800. And that indicator flared. It was July 19th. So it was during this candle. And throughout history, the entire history of the market, when the S&P has put in what appears to be, has put in a local bottom, so it's not, working on a lower low, when it's coming off a bottom and it goes from fully negative breadth to fully positive breadth, it always signals resuming the bull run, the bull market. And that's what triggered on July 19th. And I made a post about it. And I said that statistically, historically, it looks like we're going to get some up action and that the bull market is returning. And that we're not, and I even said we're going to see new all-time highs before further lower lows. And we got some local highs, and that was nice. And people were probably congratulating me for no reason. But then Papa Powell came out at Jackson Hole in the week of August 15, and he said some hawkish things, and the hawkishness just built and built. We got CPI data, and what happened is that August ended up closing significantly down. Why am I talking about this as though it changed something? Because it did. There's another indicator that in a year, basically, if the S&P closes down 10% for the year by the end of August, it signals resuming the bear market. It signals further down action, further downtrend. And I think you can already tell where I'm going with this from more or less the start of the year. I'm just estimating the numbers with the weekly chart so that it can all fit. But yeah, from start of the year to August, it was about. I think it's actually closed up a little. It was a little bit less than this. I think I measured it. I did use daily candles at one point. You can see on here it says 17.6%. It wasn't that bad. I think it was 16%, so a little bit better. But 16% is larger than 10%. 10% down, which means that that's also in 100 years of S&P history, that indicator has never been wrong. We now have two indicators that have never been wrong, and one says bull market, and one says bear market, and that's currently where we're operating. In fact, let me just mark these so I can show you next why I'm discussing these. So here's where that flashed. Let's give that a green for bull, and then we've got the close of August. Let's give that a red. Oops, shit, I switched them. I forgot to click off. Green for bull, red for bear. This is where those two never before beaten indicators both flashed. They're fighting each other. And something is coming up. We've got the end of September, which is the close of quarter 3 for the year. And if we pull out to the monthly chart and add, instead of the 10, we don't need it. Let's do the 5. Hide my drawings. So I've already calculated this, but if you want to, you're more than welcome to double check me on it. So basically, closing below, basically two red confirmation candles before the 5 month, has always led to a bear market. So, meaning two red quarters. We've got it here. Sorry. So yeah, we've got it here, which is 2011, and this is still in the bear market because it hadn't set new higher highs. So sorry if that's confusing, but this is just the first time it showed up. So we've got two confirmation candles below, 2 quarters below. You were able to buy lower, but this is the end of the bear market, so it actually led into the bull market. But the MA structure was very different. So now if we go back to where the MA structure is matching, that is the red has just crossed down through the green, for example, and all the MAs are currently bullish. So we're coming down from a bull market. As soon as you get 2 quarters below the 5 MA, 2 red quarters, it's bear market time. And here's the great financial crisis. Here's the .com. You can see again from a bullish MA standpoint, we had our 2 quarters close. Looks like quarter 3 and quarter 4 of 2000 closed below, and it was bear market time. Any other time it has bounced, you don't see this show up anywhere else in the bull market. Here's 1 quarter below, and then it immediately greened right back up. Another quarter below, and it greened right back up above the MA. You'll see this all the time, and there's no more 2 full quarters confirming below. Here was a breakdown. This is COVID again, which is an exception, but it still holds to the rule. You had a breakdown, and then here's 1 confirmation red below, 2 below. What are we working on in 2022? We've got this candle, which actually, when you zoom in, it does match up. This was a breakdown, confirmation below, rise back up to the line, never confirming back above it. So this is the confirmation candle. We've got 1 confirmation below the 5 month moving average, and closing quarter 3 below here, which it's currently at 393. I have something incorrect on here. I'm glad I'm doing this live. Was it not the 5 MA? I might have. I mean, it's still valid. Well, let's just go off this. Let's go off this. I must have had the wrong number. Huh. This is gonna be very interesting to write into a post. So the 5 MA, 5 month MA is actually 393. I thought it was 407. Why was I saying 407? Where was I getting that from? That I must have conflated a different metric. Wow. Look at me fucking up. Hey everybody, I fucked up and wrote the wrong number, and I've written the wrong number several times. So 393 is the 5 month moving average. If we close below there, if we're not green, um, historically, it says bear market is coming. So again, going back to weekly with our drawings, like this could potentially be, yet another never before beaten, at least in recent history, bear signal market, signal for the bear market. It's starting to look like either this first signal, like you'd think, and I'm just freewheeling now. You'd think that this signal was somehow overwritten because the bear signal came second. That's one way to look at it. The other way to look at it is that this market is just so fucking chaotic that these signals don't matter, and both of them are going to break this year. And I'm totally fine. I keep two heads about everything. It's perfectly reasonable that the crazy amount, like the quantitative easing and the money supply, the insanity that happened during COVID, it could have just written over all the rules, and maybe none of this matters. But as of right now, if you're just counting, provided SPY doesn't rocket back above 393 to end the quarter. I'm actually going to move this down because this is my old line, right around there. Close below there, and you get the second indicator, and that's two bear indicators to one, and that's just we're doing first grade math here, but 2 to 1, it seems like the bearish case starts to win out. Combine that with again this plunging momentum here, and maybe the indicators just don't give a fuck about what the Fed's doing. They're just going to tank this, and what yields are doing. Maybe we just capitulate now. I don't know. But again, this is a monthly. Oh, I'm stupid. Oh man, I need to stop drinking. I know why, because I was on the monthly chart and I needed to do the quarterly chart. That is why this number didn't line up. Okay. Oh no, I'm using the wrong line. I'm putting this line back up at 407. My chart is all fucked up. There we go, back at 407. I assure you, the 5 quarter MA was up here at 407. That's why I was looking at the monthly chart. Okay, so SPY's got to get all the way back up to 407 to negate this, to stop this indicator from printing. That's a long way to go in a week. Less than a week. It's actually going to be like 4 trading days, 3 trading days. But hey, crazier shit has happened. I think it's a 10% week. I don't know. Putting the indicators out there, and we'll follow them. I am clearly losing steam. Any questions for me in chat that I can look at while I kind of wrap this up? I'm just going to go into the bond canaries, our high yield bonds and investment grade bonds. But if you have any questions, now's the time. I will talk about them. Let's see. HYG high yield bonds. Yeah, they agreed with this downturn. There's a divergence here forming, which is nice. Unlike on the indices, we've got lower low in price and higher lows in the RSI and on momentum. So yeah, it looks like very slightly. So very slightly on momentum, and then quite demonstrably on the RSI, lower low price, and this is higher low RSI. So bull div on the high yield bonds. As I say, they are canaries. So maybe that's one way the SPY pulls off this turnaround. We've got multi assets, IYLD. Same thing, bull div here, which is nice, but it agreed with the down action. And then last up is LQD investment grade bonds. Pretty much the same story, I believe. 26, 21, and 27. Yeah, so bull div on the weekly. In our bond canaries. In the event, Erwind asks, in the event of a macro bear market, when is it reasonable to expect a crypto bull again? I mean, if we're saying that we're currently affected by macro, then in our bear market, then it stands to reason that a macro bull market would also be somewhat necessary. Let's just use the SPY for this. Or actually, no, even better. Let's go back to federal funding rate. That's not it. EFFR. Okay, so kind of what I was describing is that eventually we're gonna see rates stop rising. Hopefully, it's expected to happen somewhere around April. It should be around up here, and then we're gonna see those 8 months of stagnation. And in those 8 months, by the way, the market can go up, as I was talking about. The market can absolutely go up during the stagnation. I wouldn't consider that necessarily resuming the bull market. It might hit the old all-time high, but yeah, in terms of a new cycle starting, I would say we get the 8 months out from there. So December and or perhaps January 2024, I would expect the rate cut, which is probably the hyper dump, the recession, probably starting in like early 2024. How long have they lasted before? Not counting COVID. The GFC lasted, and I don't think this is going to be as bad as the GFC because there's not as much destruction. Banks don't do those giant mortgage don't have those giant mortgage portfolios anymore. So you figure, after the dump, September 2008, big dump in November, and then it pretty much saw the bottom. So I don't know if you're counting buying off the bottom, which was really only about 5 months from September, and I don't think it would be that long this time around. 5 months, and then it broke back above with higher highs, or broke above, the pivot point in December 2010. And that's this area is probably where crypto would come back in. So you figure like, probably mid 2024. So you figure that's 6 months out. So yeah, somewhere in here would be probably the start of the next cycle. So probably mid 2024, summer 2024. I'm just going to take a quick look at the .com as well to see how long that lasted from the bottom. Different metrics here, but this was August until it did start climbing back up. I think mid 2024 is probably where macro. If we have this rate hike, stagnation, and then rate cut into recession on the timeline that I proposed, the rate cut happening in December 2023, January 2024. Probably mid 2024 is the earliest the bull market would. It's probably the earliest we would have like a floor in macro to build off of. Bird is a word asks, do you still think that ETH bottom is in? I've been responding to this quite a bit, and we came up with the donut indicator pretty much like I started looking at it. I say developing it, but really I was just looking at some lines. I came up with the donut indicator maybe a couple months before. I was looking at it in like March, April, and I only wrote about it. So that's where it counts. I wrote about it like 2 weeks before we got the trigger for the bottom, where we talked about how when the 1 second, let me put back on the 10 MA. So basically, the 10 going below the 100 week was had marked bottoms, or said a bottom was coming within days, and boom, here's the donut indicator. Here's the current bottom. That's worked for past cycles. It also works for Bitcoin. At this time, and as I keep saying in write-ups, until something breaks, I have no reason to think that this wasn't the bottom. Now, you can see ETH is dojiing on top of this channel. This is a bear flag, now it is. Here's a flagpole. Here's the bearish flaggish continuation. This can absolutely break down. What's going to cause that? what do you think? The market's losing the 200 week. If we see, the indices go below the 200 week, ETH's coming down, and that would constitute something broken, and the indicator probably fails at that point. I don't know why we wouldn't set a lower low if SPY heads down to like 340 or 320 or something like that, which is kind of its largest extensions. You've got heck, even just to reach the 200 week, SPY has to go down a little bit more. But yeah, 340 and 320 are big targets for SPY. If it goes down there, I don't know why ETH would for some reason survive all that. I know it showed strength yesterday against the market drop, but with that amount of anchoring to the markets, I don't see it surviving a drop like that along with the indices. But as of now, yeah, I'm sticking to it. Nothing. We haven't seen things break, and so I have to I have to stay optimistic based on the data that the bottom is in. I have made comments saying I do think Bitcoin, and I typed these comments before this week, by the way, but I have said that Bitcoin would probably set a lower low, but get a bull div, a bullish divergence off of it, and that would send Bitcoin back up, and in turn send ETH back up. Currently that's playing out. I wasn't quite as sold on the donut indicator for Bitcoin. It was pretty close, somewhere around here, and we did get a bottom within a couple weeks. What at the time was a bottom. But as of now, yeah, we are seeing currently a lower low on Bitcoin. Actually, well, a lower low close, not a lower low overall. It would have to drop below 17.5 for that. But right now, yeah, we're looking at a lower low with a bullish divergence. Everything is still in place until something breaks. Things like that indicator on the SPY firing or the indices leading the 200 week, that would constitute breaking. And, I'm not so proud that I'm going to say, ETH can't go to a lower low at that point. As of now, I do think the bottom is in. Erwin continued by saying, oh, sorry. I thought you had another question. I'm counting buying off the bottom. Okay. So looking for sustained positive price action. Yeah. Obviously, as the advice always goes, don't try to time the bottom. And I'm not here to give financial advice, but I will say that if you're first of all, if you're a long-term investor, I mean, I think most people would agree this is a spectacular time to buy, for your broad portfolios and stuff like that. I mean, the risk reward here is still pretty well. First of all, it's incredible for like a 20-year timeline, and even in like the 5 to 7 to 10 year. I mean, is it going to take that long to recover? Even in the most dire situations, we haven't seen the market take that long. I think tech was the longest to see a new all-time high after the great financial crisis. It was like a full 4 years. But like I just said, I was looking at the long-term timeline of like 5, 7, 10 years. It's a pretty good time for those kinds of investors. Midterm, within like the 1 to 3 years. Yeah, the risk goes up a little bit again because they're going to be looking at this 200 week. But in terms of loading up for mid and long-term investors, this is a pretty good area. And if you're only looking at crypto, I'm scaling in. Like I can talk about my positions. Like I'm buying. I'm scaling. I'm absolutely scaling in. I was scaling in, on the donut indicator. Back on. Back when we were, we broke down from 1400. Once we broke the all-time high is when I was scaling in. I actually started buying and stopped buying at this right around this level. I think it was actually like a little lower at 1050. So I didn't actually get a ton of. I only got some for posterity. I didn't get much in the 900 range. So scaling in is smart. At DCA, as they say. Looking for the actual bottom. I mean, you're kind of one of those people who's going to be watching this week's action because you're going to be looking at the indices and the 200 week. You're also going to be looking at even here, crypto's basically, ETH is dojiing at the 200 week, just above it. So yeah, you're going to be one of those people who's got eyes on, because if this 200 week breaks in indices or in crypto or both, without divergences, there absolutely could be a lower low bottom. That's what I was saying about breaking. But scaling into it, ETH is going to have major levels. First of all these levels that it touched before, you're going to have a chance at 1,050, and of course at 900, 700 range is a historical level. Um, it was a pivot here in 2020. You'll have chances to scale back in. Yeah. So yeah. DCing through the bear market so far, if that's what you're doing, that's fantastic. These are excellent levels to accumulate. Um, for I mean, with the stock market, I was just saying, like, if you're on the 1 to 3 year time frame, maybe there's some more risk for you there. If you're nervous about the 200 week breaking, but for crypto, which is higher beta, high volatility, 1 to 3 years is a lifetime. And as I said, like, we could absolutely get a restored bull run during the early recovery of macro in like mid 2024. This is a fantastic time to accumulate for mid 2024. I mean, that's nothing. Do you really think that we're going to stay below, like, let's say we set a new lower low? You really think we're going to stay below like 850, 750 into 2024? So I think it's a great time to accumulate. Managing your risk. Historically, it's a great time to accumulate. We're seeing coming off an oversold RSI back in 2018. This was absolutely the time to accumulate. There are some scary moments, including in 2019 and 2020, but it all pays out. It all worked out okay. In the 1 to 3 year horizon. Obviously, we're up like 400% from there, 500%. Um, and so yeah, I think that's a great plan. I'm back in. I'm buying. This is my buy range. I'm actually a little nervous because I'm sticking to my plan, which was as soon as the all-time high broke again at 1450, 1420 area. Oh, sorry, the old all-time high. I'm a veteran. So once like 1420 broke, was where my buy area started up again. I'm very nervous. I'll be honest with you guys. I'm a human being, but that was my plan, and I got to stick to it. I'm gonna keep buying. I also had the benefit. I was shorting. I was out of the market December. Basically as soon as this broke. I think it was like December, right around this week, was when I was out of the market, and I was shorting all the way down through the summer. I got very lucky um, on the April turnaround. But yeah, I shorted from, I think I was all out or I was shorting by like 30. I don't think I got the top, so maybe I was down at like 3,100. But yeah, 3,100 down to, and then I closed my short at 1,500. So no more shorting. I'm done with that. I'm buying. I'm excited. If things break and we set a new lower low, I'll keep buying. So yeah, that was a lot. And I did promise a quick calendar. There's not a ton coming up, so this week's going to be a lot of just natural price action. You've got home sales and personal spending, which aren't terribly major things. The big things to look forward to, not look forward to, sorry, look at, will in fact be in October. The three major events are certainly going to be CPI on October 13. Why is it not showing up? Oh, FOMC minutes. Sorry, FOMC minutes are on October 12th. CPI is on October 13th. And then China, which doesn't show up on here, China has their Grand Communist Party policy meeting on October 16th, where it's rumored that that's where they could restart manufacturing and supply lines and turn off COVID zero, for better or worse. That could be a massive event, especially combined with seasonality, because mid-October is like prime time for markets to reverse. So if we do see a little more red, mid-October in this week, 12th, 13th, 16th, we're absolutely going to be talking about it more and more as we get closer to it. So yeah, not much news this week. October's going to be big. That's pretty much it. I'm going to hang it up for now. This was a long one. I'll have chapters up for everything. Thank you guys for joining. And yeah, appreciate the good questions. See you guys next time. This has been 51% Attack. See you guys on Reddit. You got it, man.